So, in the previous PPT, I have discussed about income tax law and practices, in that income from house property. Regarding income from house property, a part of the income from house property I have discussed in the previous slide, that is what is income from house property and how it is being calculated. I told you that let out property and self occupied property, and format also I have discussed in the previous slide. See, to calculate this gross annual value in the format, I have given a procedure. So, there are 3 steps which I have discussed in the previous slide. Then what is gross annual value? After that net annual value, there may be some deductions, but before net annual value, municipal taxes will be deducted. After deduction of municipal taxes, you will be getting net annual value. After net annual value, today I am going to talk about after net annual value. As I have given the format starts from gross annual value, then you will be deducting municipal taxes, you will be getting net annual value. From net annual value, there are deductions under section 24. There are 2 important deductions you have. One is standard deduction and another one is interest on borrowed capital. So, deductions allowed for let out property or deemed to be let out property. There are 2 deductions. One is standard deduction under section 24A. Second one is interest on borrowed capital under section 24B. So, you can claim 30% of net annual value. From net annual value, 30% if you calculate, you will be getting standard deduction value, which will be coming under section 24A. And interest on borrowed capital, whatever the amount which you are paying as interest to the borrower, say to the concerned person, that will be entire amount will be allowed as deduction as far as let out property is concerned, right? But there is some restriction regarding this self occupied property. As far as a standard deduction is concerned, you don't get any standard deduction for self occupied property because the values are nil, right? So, you cannot calculate this this standard deduction also. So, that also will be nil as far as self occupied property is concerned. But you may have for let out property and deemed to be let out property, you can claim 30% of net annual value. But as far as self occupied property is concerned, you can claim interest on borrowed capital. Interest on capital borrowed for acquisition, construction, repairs, renewals or reconstruction. So, it is allowed. This is being classified into 2. One is pre-construction period interest, another one is post-construction period interest. Now, just I tell about this pre-construction period interest. Interest paid in pre-construction period is deductible in 5 equal installments from the year of completion of construction or acquisition of the property. This is very important that when you start claiming this pre-construction period interest, see, the house must be completed, the construction must be completed. That is why I have given here interest paid in reconstruction period is deductible in 5 equal installments from the year of completion of construction. That is very important, right? Or acquisition of the property, the day on which you are purchasing a property, you are buying a property, from that day or that year onwards you can claim for 5 years, right? Pre-construction period refers to the period commencing on the date of borrowing and ending on 31st March immediately prior to the date of completion of construction or acquisition, whichever is earlier. The pre-construction period when you take, it refers the period commencing on the date of borrowing, in which date you will be borrowing the principal amount. From there you will be calculating, and ending on 31st March immediately prior to the date of completion of construction or acquisition, whichever is earlier. So, next is interest on borrowed capital in case of self occupied property. See, where the property is acquired, constructed, repaired, renewed or reconstructed with borrowed capital on or before 1/4/1999. See, if you get any loan on or before 1/4/1999, the deductible amount of interest will be actual amount of interest payable or rupees 30,000, whichever is less, can be claimed as interest on borrowed capital. I repeat it once again. See, where the property is acquired, constructed, repaired, renewed, or reconstruction with borrowed capital, that may be on or before 1/4/1999, the amount deductible will be actual amount of interest payable or rupees 30,000, whichever is less, can be claimed as deductible amount, interest amount. Where the property is acquired on or after 1/4/1999, see, if the property is acquired or constructed, when you claim this interest on borrowed capital, it will be falling on or after 1/4/1999. See, in that case, the deductible interest amount will be actual amount of interest payable or rupees 2 lakh, whichever is less. This is meant for self-occupied property. As far as at the same time, any repair, renewal, renovation or reconstruction, the same self-occupied property, if it is after 1/4/1999, see, the interest deductible is actual amount payable as interest subject to the maximum of rupees 30,000, you can claim as deductible amount. But as far as the lettowed property is concerned, as I told you earlier, that there is no restriction at all. You can claim any amount. See, whatever the amount which you are paying to the particular capital value, principal value, that entire amount can be claimed as deduction under section 24, in that too under the head interest on borrowed capital. So, I repeat once again. See, when we talk about the calculation, after net annual value, there are two deductions. One is, see, standard deduction, another one is interest on borrowed capital. As far as self-occupied is concerned, standard deduction will be nil, and lettowed property is concerned, interest on self-occupied standard deduction will be claimed 30% from net annual value. The second deduction is interest on borrowed capital. If it is self-occupied property or ordinary, that is a lettowed property, you may calculate pre-construction period interest. See, that pre-construction period interest may be claimed or may be deductible in 5 equal installments, right? And as far as self-occupied property is concerned, the interest on borrowed capital the interest may be deductible by following these conditions. One is, if the property is acquired or constructed or repaired on or before 1/4/1999, the amount deductible will be maximum of rupees 30,000 or actual amount payable, whichever is less. If it is acquired after 1/4/1999, actual amount of interest payable are rupees 2 lakh, whichever is less, may be claimed as deductible interest amount. And at the same time, see, money is borrowed on or after 1/4/1999 for repairs, renewals or renovation or reconstruction. The deductible amount of interest is actual interest payable subject to a maximum of rupees 30,000. Then after deducting these two deductions, the balance what we get will be called as income from house property. I hope you can understand how to calculate income from house property. We will be starting from gross annual value, then the municipal tax will be deducted from gross annual value, then what you are getting will be called as net annual value. From net annual value, two deductions, one is standard deduction and the second one is interest on borrowed capital. After these two deductions, the balance what you get will be called as income from house property, which will be called as income from house property. So, thank you, students.